Welcome to the Newbie Real Estate Investors Podcast. Today, we're going to go over how it is to be a loan officer. How do people get funded? Explain a little bit from a loan officer point of view.
I think this is one of the most trickiest parts of the deal, right? Yeah. Mm-hmm. Because once you do the ARV and you know that you're buying the house for $200,000, but you're going to be able to fix this because you have an extensive knowledge of construction, that you're going to be able to sell this thing for $450,000, $500,000, right? That's easy as long as you keep your costs low and everything else. The financing, I think, is one of the most important parts and where the entire deal can just collapse. Financing, you can start with as little as 3.5% with an FHA loan, or even a conventional loan. You could put down at least 5%. One rule of thumb is never mention to a bank that you're buying an FHA loan to do an investment. Don't follow what you're hearing on social media. FHA is not an investment tool. It is a property that you're intending to live for 5, 10, 15 years, but they do give you the option to move out. Let's say you've outlived the house, your family size is growing. You can move out after a year, right? You're not breaking any rules after that period. But FHA is not an investment tool. Don't say that to the bank. You can start with as low as 3.5% down. So Joey's fixed up this property. It's ready to get sold. There's no encumbrances or any other creative financing that's attached to this. You can, again, FHA 3.5% down, closing costs about 3 to 4 rule of thumb. If you're looking, let's say Joey just wants to get rid of it. He started the deal and his whole construction crew just for whatever reason just left the job site. You can pick up that property as long as he's had it for over 90 days and you can do a 203K. This is one of my favorite loan options for 2024. With the lack of inventory in every market across the country, 203Ks are going to take off this year. It's just imagining what you can do with this actual loan. So Joey leaves the house down to the studs. You can pick up a home with a 203K loan where it's like an FHA loan, it's the same thing, but the bank will give you the money to finish the repairs of the house. Again, down to the studs. No luxury items. They're not going to install pools. They're not going to install pickleball courts. They're not going to install tennis courts, right? Yeah. No spas, anything like that. But they will give you the money to actually finish off the entire house. That's for your basic entry level. And there's no additional cost to it. A lot of people think, 2 or 3K, I have to put X amount of down. You have to put more down. There's really the only additional fee that I could see on a standard 2 or 3K would be having to pay for a HUD consultant, which run you about $800-900. Basically, that's going to be your project manager while you're going through the 203K loan. Now, if you're looking to be a little bit more creative, we have what we call non-QM loans. Non-QM loans are basically where you're putting down 20% and you're putting less documentation to acquire the property. These are what you're hearing online, your DSCR loans, hard money loans, bank statement loans, but the DSCR is the most popular. You're putting 20% down and you're actually going to acquire the property, not with your personal W-2s, income, work history. You're actually going to qualify with the projected income of the rentals. If you have a mortgage payment of $1,000 and the projected income of the rentals of a 2-unit is $1,100, you're most likely going to qualify with the bank. DSCR, again, it's the most popular product right now in the industry. You can also do hard money to pick up a property where it may not work with the bank for whatever reason. Again, you're looking to put 20-25% depending on the relationship you have with the bank. They're going to actually give you the money to buy the property, and they're going to, again, give you money to fund to fix the construction or complete the construction of the property. But that only lasts 12 months. I help you with the hard money, which I can do. And then after 12 months, the job is completed. Now we're going to figure out an exit strategy. Also, BRRRR. Everyone hears the term BRRRR, right? We buy, we repair, we rent, we refinance, right? And that's where I come in. I always call myself the third R in the BRRRR. And then we repeat. BRRRR is one of the best ways to actually pull equity out of a property. So basically, you're going to buy something for $100,000. You're going to put another $100,000. It's going to, and you know that because you've done your due diligence. You've connected with a realtor that you can sell that property for $400,000. The bank will give you up to 80% of the projected ARV on the property. So those are the best options right now, and some of the ways that you can actually make money while making money with other people's money, which is what I always recommend.
Awesome.
That's when we check out the episode with Daniel Wang where he literally told you how to use people's money for
Absolutely.
everything.
Daniel was a great episode.
Yeah, he was.
So thank you guys for tuning in, and tune in next week for another episode.